Hill Center, and I've been working with a number of people to put these panels together, including Matt, who's on the panel, and Matt Pasiga, who's helped out back there, and Kathy, and I don't know if anybody else is in the room. But this is our last funders panel, and it's about equity, and we have 3 VCs on the board. We've already gone through debt, non-debt, and bootstrapping. Those videos are available online. I'm really excited for this last one. I think it's going to be a great panel. We have Nate from StickyAlbums and StickyAPPS, who's our founder. You might have just seen him in the Pioneer Press. There was an article this Sunday. He's a 1 Million Cups alumni, and every Sunday in the business section there's a showcase of startups who've come through 1 Million Cups and where they're at now and what they're up to. So he has now been published in the Pioneer Press, which is great.
Big news.
Big news to his family for sure, he is saying. But really happy, really happy to have Nate here. So this is gonna go for an hour, 8 to about 9, and then we have a startup pitch right after. I would love it if people stuck around for that. It's a great opportunity to hear from a local startup, and then you get to participate by helping them out, giving them feedback, and helping move their business forward. So with that, I'm gonna just turn it right over to Nate. And this microphone is for you guys to share.
Cool.
So you can pass it. Yeah, don't fight.
Awesome, thank you, Lee. Again, I'll introduce myself. I'm Nate Grahek, local founder here in the Twin Cities. I started my own business back in 2012. It's been a fun ride, and the local community has always been really supportive. And so I jumped at this opportunity to kind of help moderate. And I also wanted to give another thanks to Lee. Since doing Million Cups, I'm just always impressed with how much you're hustling to get the word out about this. There's so many meetups going on. Lee's going the extra mile to get guys published in the Pioneer Press, get on the radio. Thanks, Lee. It's a huge thing to see how much work you're doing. So I always appreciate hustle. I did some research to get ready for this morning last night. So who's here is a fan of Shark Tank? Do you guys like Shark Tank? I think it's a pretty cool show. I think it's a good thing that they're doing a lot of good things, but there's also some myths that they might be perpetuating in the venture scene. And so I kind of have a little axe to grind about raising venture. I think that I'm excited to have these guys here to go through why venture is a good thing and why it isn't a good thing for some people. We're going to go through all of those items, but first I have a quick little question, icebreaker. So I'm just curious, just last year, I'm going to see if you guys know too, how much venture was invested in businesses in 2012? 49 billion, 69, or 89? So everybody, if you think it was 89, raise your hand. I think it was 69. It was actually 49 billion. So if you look back over the last couple of years, we're not quite in that like huge year 2000 bubble. Nobody wants to say that word right now. I think we're fine right now. But there's a lot of press. Like VC gets a lot of press. And with Shark Tank and all of these other big investments that are happening, it's a fun thing to talk about. And it's a lot of times investments and people raising and cashing out, it gets in the press. And as a result, I think a lot of people end up thinking that it's the only way to go. If I have a startup business, I have to raise. So I wanted to start talking about some of that stuff. So throughout the conversation today, I'd like to cover these 3 points. So you won't raise VC, at least 99% of us. The odds are so small. I want to just level set. The likelihood is so small. I want to try to make your guys' job easier. We can do some pre-qualifying for you. If you still are convinced, you think you're interested in VC, we can talk about why. What are the right reasons to take VC? And then because the conversation is about equity, and I want to make this conversation as valuable to all of you as possible, one of the more likely conversations I think that would happen or experiences would be offering equity to a co-founder or to an employee in your small business. Getting off the ground, a lot of times we see, well, I've got tech talent but I have no marketing, or vice versa. I need to find a tech co-founder. What do I go about doing that? And we could talk a little bit about using equity to get that done also. So let's first start with some myths, guys. Raising VC is the most common way to start a business, and raising VC is the first step. The irony is that it's probably the least common way, and it's not the first step. So like I said before, all of this press is like, oh, this is like just get your bucket of money and go start a fun business, get the nice computers and the expensive chairs, and you're off to the races, right? There's a lot of ways to do it. So what are some, there you go, you can have a ping, or shuffleboard. So what are some of the other myths you guys see in the entrepreneurial space when it comes to raising money? You want to kick it off?
I guess I'd say it's an unrealistic time frame to exit.
Yeah,
it's like, oh, I'm going to put in 3 years and I'm going to sell this for $200 million.
Yeah,
it's
right.
Like, well, okay. Probably take a lot longer than that.
Yep.
And I mean, that's just off the top of my head, one
right
thing.
Totally.
Yeah, and I would add to that a little bit. I just think it's the amount of time it takes, even, and I'll take the earlier side from what Matt said, the amount of time it takes to get to the point where you're ready to accept capital. I think a lot of times entrepreneurs think, hey, I've got this idea, I'm going to go raise capital in the first 6 months and then be off to the races. And when you look at a lot of companies here locally that are having success, One I Work is a great example. It took Chad Halverson 3 years to get to the point where he was ready to raise a Series A. Clay Collins with Lead Pages, it was a little faster, but he was working on his own kind of services work and building his blog for a period of time. So I think that there's kind of a lack of understanding of how long this stuff takes, and that's okay, right? If you look at some of the largest businesses, it takes a few years to get to the point where they're ready to take money, and then to Matt's point, once they take money, oftentimes it can take 10, 15, sometimes 20 years in order to really build to that outcome that the entrepreneur wants. So I think that's time is probably the biggest thing that I see.
Good stuff. So let's back up a second and let you guys introduce yourselves. So start with Ryan. Tell us a little bit about your role and the types of, I've got a later question about the types of businesses you're looking at. Sure. Just say a little bit about your
So I'm Ryan Broshar with Matchstick Ventures, formerly known as Confluence Capital. We invest at a fairly early stage with smaller checks for that, and then we usually allocate for follow-on investing. I guess I won't go into our focus, but we're based in the Twin Cities. We really invest nationally. About half of our companies are in the Twin Cities. We have 15 investments to date over the last 2 years. Half of them are in the Twin Cities, but we also have investments in Seattle, Chicago, Boulder, Denver, St. Louis, really across the board. So we're based here locally, invest nationally, but we also try and bring a lot of capital back to this area for our local investments.
Nice, dude. Matt.
I'm Matt Otterstatter, partner at Vilicus Ventures. We're here in Minneapolis. We have a sort of weird way that we got started. We bought 2 funds. So the funds that we have are fairly well established. So we have very mature companies, sort of pre-IPO or pre-acquisition. So they're much later stage. But we're also in the process of starting a smaller fund as well. So, and that one's going to focus on health IT.
I'm Pat Meenan. I'm a partner with Arthur Ventures. We're an early stage venture firm funding companies at the seed and Series A level anywhere outside of Silicon Valley. So similar to Ryan, kind of all over, except we don't go in California. And yeah, we invest up to $3 million initially, but are most often putting in $500K to $1.5 million in rounds of 1 to 5.
Cool. I think let's slow down a second and just talk about the difference between what you guys would call seed and angel. Let's put some distinction there. So when you guys are making, you say early stage, let's contrast that with what we were just got done talking about is there's sometimes years in front of making a deal with you guys, right? So what's the distinction for doing like crowdfunding or angel investing or other ways to start before taking like what you guys would call seed or early stage?
Where we usually invest is after the friends and family, after the angels on that level. And, I think the definition of seed, bridge, A, B, whatever, is incredibly loosely held. It's more about what are you trying to raise or what milestones are you trying to hit based on the raise that you're doing. So when I say early stage, I purposely do that because it's not, we only do seed or it has to be labeled C or they've been called everything on that. It's much more of like the milestones that in the companies that we look for is something where they've already got a product built, they already have a customer, and now they're looking to go from, they've already gone from 0 to 1 and now they want to go from 1 to 100, right? So they've got kind of their plan in place, it's already been validated, and now they want to really ramp it up. So what round is that maybe 4 rounds in, based on where the angels are, and then depending if they're pivoting or where they're going. But it's much more of like, okay, we feel like they've already validated where they're going, and we want to help propel that.
So is one of the good distinctions to make is that with angel, it's oftentimes just a person and their money.
Oh, yeah.
And whereas you guys are investing other people's money also, right? And how that impacts what you're looking for?
Yeah, I think definitely at the seed and the seed level, regardless of, like I said, the definition of that, I think it's still very much about the team and where they're going. But earlier it is, the more they're just like, hey, Nate, I believe in you, and here's my money, and hopefully I get it back. And they're kind of looking for that upside. That later on, you get it in the rounds, the more it's based on metrics, market adoption, customer retention, et cetera.
Yeah.
So I think it goes from a qualitative to a quantitative judgment the further along you get.
Cool.
To build on that, one other thing, if you're taking institutional money, is, as a VC, you have investors, and they have a strategic reason for investing in you. So it's much more important than it would be for an angel to have that strategic fit. Because if I go make an investment in artificial intelligence, and I told my limited partners I was investing in healthcare, they're going to get really pissed off. Right? I mean, that's just plain and simple. So you have much less leeway. I mean, that's an extreme example, but you have much less leeway, even within your focus, to deviate. So it's really about fit.
Cool. I think that's a really good point. I want to slow down and even go into what a limited partner, I didn't know what that was a couple years ago. Explain that process and how you guys, to start a fund, have to set expectations about time frame, so that everybody, not just the businesses you're investing in, but actually the LPs that you're working with, everybody's got to be on the same page as to what they're looking for and the types of deals they're looking for, right?
Yeah, so sort of like, where does the money come from?
Right.
We're not just money trees, right? You don't just you don't just have it. So we raise money as well, and I mean, I can share sort of my perspective and you guys as well, but generally speaking, limited partners are wealthy individuals, family foundations, maybe some corporate entities that want to get visibility into a certain particular niche. But in general, they're writing large checks. So it's not your average person that wants to go on Fidelity and say, I want some venture. It doesn't work like that. You have to be an accredited investor for one, which that bar may rise. We'll see. But right now it's set at about $1 million, not counting your house. So that's a pretty high bar right there. But typically, you should only invest in venture if it's discretionary money. It's money that you can afford to lose because it's very high risk, very high reward. And that portfolio allocation, like if you're CalPERS, the California Public Employee Pension, whatever, they have billions of dollars, and they put, I don't know the number, 5% maybe in venture, and even that is billions of dollars. So for them, they're trying to spread their bets across the top tier venture funds, because what they're trying to do is optimize that portfolio. So it's not just about having bonds and having some public securities, but this is that little growth engine where if it hits big, it's going to be huge, and it's going to drive returns when other asset classes may underperform. So it's all about balancing your portfolio. So for an LP, again, you're a wealthy person or family foundation that you're just putting a small little bit of money in, and you're saying, I want this to be the potential to get 10, 50x.
Right.
And so you want us to take those big risks. So that kind of forces us in terms of the companies we're looking for. And that's why you said 99% are not relevant for VC, because if you're starting a restaurant or some other small business, that's not a high returning prospect. It's got to be the potential to change the world, basically.
Yeah. Cool. Patrick, anything to add to that?
Yeah, I mean, maybe just a little bit more tactically, right? So we go out, so we're currently investing out of a $45 million fund. So we closed it in 2013. So we went out to investors for about 9 months with, our pitch on where we want to invest, what we want to invest in. Then we got commitments for $45 million. We don't get all that money on day one. So it's not like we've got $45 million sitting in an account. We call it over time. So we call about roughly probably about 20%,
okay.
A year for the first 5 years. I mean, it depends a little bit on follow-on in the out years. Mm-hmm. And we kind of call it in as needed, and we make investments, and we kind of report back to our LPs similarly to how an entrepreneur would report back to their board. It's a little bit less frequent, but I mean, we have to give an overview of our investments, our strategy, how things are changing. And yeah, I mean, at the end of the day, we're accountable to our limited partners just like an entrepreneur is accountable to us.
So let's slow it down to some more basic stuff. So the reality, as you touched on this, is that it's very high risk startups everybody's got their anecdote of how many, 9 in 10 startups don't succeed, right? So, but there's these great moonshots. There's these amazing stories of WhatsApp and Instagram and all these amazing 50x, 100x returns that everybody likes to think about. Can you explain how the hit rate, the reality of the situation impacts the types of businesses that you have to look at?
Yeah, no, it's a great question. And so I think we'll use a really simplistic example. So let's say you raise $100 million for easy math. And we can get into details on what it takes to be successful. But let's just say that you're expected to return $300 million to your limited partners. Okay, so that means you take 100, you deliver back 300. Well, how do you actually make that happen? Okay, so let's say you're a Series A investor and you're typically acquiring, we'll call it 20% of a company. Okay, and you have to basically figure out, how do I actually get to $300 million? So if one company was going to return my fund, I would have to own 20% of a $500 million company, right? Now I would have to do that 3 times, right? Or I could, obviously own 20% of a much larger business. But I think that kind of paints a little bit of a picture on how you have to have outlier returns in order to return a lot of your fund. Because when you just look at statistics, you're not going to have, you're not going to invest in 20 companies and sell, 18 of them for $100 million and just stack it all up. And so for a lot of that, you'll hear investors, 1, care about ownership percentage, and 2, care about return potential. Because if they're looking at something and they think the ceiling on that business could be a great business, but I have a hard time seeing it sell for more than $50 million, it might be hard unless they have a smaller fund, right? So if you're investing out of a $5 million fund, that might work. But the larger your fund, the larger the exits have to be, which is why you'll see a lot of these very large funds. I mean, no one the size here in Minnesota, but in California, these billion-dollar funds. That's why people are chasing, the Airbnbs and the Ubers or what have you, because it's just the statistics show that returns are really concentrated within a select number of companies, and it gets harder and harder the more money you manage. Does that kind of get at what you were?
It's perfect. Yeah, saying? I think I'll add some of my own experience. So when I started StickyAlbums in 2012, we skyrocketed the classic stereotypical hockey stick growth that everybody says, this is awesome, you've hit the jackpot. In the first 2 years, we made it to $1 million in revenue, 5,000 customers. Everybody, different peers are like, wow, are you going to raise? Are you going to raise some money? Are you going to raise some money? Says, no, I'm not going to raise money because I don't see this going to, there's no realistic story I can tell to take this business to $10 million in revenue. The market is about this big. I've almost already tapped it. By somebody giving me a bunch of money isn't going to help me turn this business into $100 million or even a $10 million business. So I think that's the other part that VCs, or one of the myths, is that you could have a very healthy, comfortable, profitable business and VCs don't care. That's almost something they want to avoid also, because that's almost, it's not considered failure, but you've got to find a business where you can realistically see it giving you 5, 10.
Do you want to comment on that? Because Matt manages some very large funds. That's probably a really good example of, how are the winners concentrated within the funds that you guys purchased? You have some very high-flying companies there, so I imagine you've seen the math pretty well.
Yeah, you're absolutely right. One of our companies returned 100, we have 2 funds, and both funds invested in this one company, and depending on how you look at the rounds, one of them it was 100x, one of them was 80x. So that particular company returned on the fund 5 times the fund. Yep. So that's everything, and the other is all added. You could lose all your money on all the other companies, and you're still good, and that's absolutely how it happens. But I wanted to comment on your point about, do you grow or do you sustain the business? And I think that's a question each entrepreneur needs to look at, both for their risk type, but also what is the opportunity? Because if you're going to build what I'd call a lifestyle business, something that's just great for you and your family, and it hums along for 30 years, which I got to say is very typical of what I see in Minnesota compared to the West Coast. That's the mentality, which is fine. I'm not trying to say that's a bad thing. That's a good thing. You've lived the entrepreneur dream in America. You've built something and you grew it to a point where it sustains you, and it's awesome. However, in venture, it's about that outsized return. And I just talked with an entrepreneur yesterday who they're trying to raise their second round, and they said, we're going to get to profitability by the end of the year. And I said, what are you talking about? Why would you think about trying to be profitable? I don't care. You have to grow, because your opportunity is so big that you've only got 0.1% of the market right now, and you've just doubled every 6 months. Like, what are you thinking?
Yep.
Because when you try to become profitable, you take your foot off the gas pedal, and you stop growing, you stop investing. You're just sitting there going, great, now I can take cash out and I can run this like a lifestyle business. When you had the opportunity to be one of these unicorns,
Right.
and to me, that's a mentality that as a VC, it's like, that's what I'm looking for. That's
Right.
the diamond in the rough, and you have it. So
yeah.
you have to grow.
Interesting. That's a good. I think it's about finding the right match and knowing your own as an entrepreneur. What's your appetite for risk, right? What do you want to build? Is the pie big enough in this solution you've created to grow to tell that unicorn story? Like a restaurant isn't going to be a 100x return, right? So very good stuff. Let's move on. Ryan, if you want to take this question, what are some more good reasons that you would recommend taking venture?
Sure. I think, well, one thing with when you take VC money, it really helps organize your company a little bit too because of the diligence process you go through. So VCs see a lot, right? Like you look at a lot of companies. And the classic is you look at 100 companies, maybe invest in one of them. And sometimes it's even more. But so you see a lot of that and you see a lot of trends and you kind of know what's going on a much larger picture beyond just like what's happening in your office. So you can provide value on that level. Have you thought about this? Or, we're seeing trends that are going in this direction. And then there's also a network effect with the VCs. So we have 15 companies in our portfolio. They interact on a constant basis. Like, hey, I've got this problem. They'll email it out and they'll start to interact and kind of basically problem solve with each other. So there's a really cool network effect beyond that. And in addition, if you're going to take VC money and you're on that high growth path, I mean, there's always a potential for more investing later, not only from your existing VC, but maybe from within their network of other VCs that they may know and co-invest with. So it's more about this, strategic side of it. And I think it's definitely something, if you do go down that route, you should definitely interview your VC on the flip side of saying, is this someone I want to interact with? Because you're getting married to that person if you like them or not. They're going to be, you're going to be reporting to them, you're going to be talking to them, you're going to love them, hate them, all that stuff. So make sure they're a good fit on that. But you want to have that, not only do they bring the money, but do they have, kind of this other tier of stuff that they can provide to you.
I think that's probably the biggest point that I didn't realize up front is it's more than just money, right? Yeah. So do you guys want to add to that a little bit? Besides the money, what else does an entrepreneur get when raising venture?
I'll just say one thing. I mean, presumably expertise.
Yep.
Hopefully, someone on the team has the operational background. They've been there before. They've seen those pitfalls. They know how to give you that advice.
And that's the benefit of you guys being so focused, right? Typically, a fund will focus in a specific niche. So you've got experience both in your own expertise, but then other businesses that you guys have invested in, you can share all of that knowledge within each other.
I say presumably because you have to look at the background of
Right.
the VC, and this is more of a Valley kind of thing where you see a lot of guys, they go through the investment banking path, they've done a lot of the quant stuff, but they don't know jack about running a company or managing a project of any kind, and so it's all about the human dynamics and the team and how do you solve those issues. And at the end of the day, the numbers could look great, but the team could be falling apart or vice versa. And if you can't manage that path, so know who you're dealing with, like you said, as a VC.
Right on. All right, Patrick, if you want to touch on a couple good things, otherwise we can skip to what are some of the bad reasons. Why should people not, if they've got more misconceptions or reasons why you shouldn't, you guys aren't going to come watch my kids also, are you?
No, I think that I personally think one of the only really bad reasons to do it is because you think you're supposed to.
Yeah, good call.
I think that's probably the biggest mistake I see people make is they just kind of think, hey, I'm supposed to be doing this versus it actually being the right thing for their business. Mm-hmm. And I also think people don't think enough about the sort of folks that they're working with and choosing their partners intentionally. I personally, as much as I like to think that we add a lot of value for our entrepreneurs, I view venture capital as just a huge benefit being money, right? At the end of the day, it's money. I think our entrepreneurs really like working with us. We work our ass off to try to help them. But I have no qualms about the fact that Lead Pages is growing really fast because of the team. right? And I think our capital enabled them to take a lot of risks, right? And I think that Clay would say we're very supportive, and I would do it again, right? But, we weren't there like ringing product ideas for Clay Collins on what was going to resonate with the customer base, right? So I think some of the bad reasons, again, is just because you think you're supposed to. And I think sometimes it's bad to do it when you're kind of in an exploratory state. I usually think that taking capital, you always have to think about how it ties to growth, to Matt's point earlier. So I think a lot of times when it's exploratory in nature, you can get in trouble pretty quick.
Yep. Cool. I've got another little bumper slide here. So out of that $49 billion, what do you guys think, what percent was in initial investment? So the first time the business took money, was it 75% of that $49 billion, 50%, or 15%? If you thought it was 75% went to first time investments, raise your hand. You guys are learning. I like it. It was only 15%. So, and then of that 15, only 2% of that 49 was in a seed round, right? So there's all of this press, there's all this money, everybody's investment crazy, right? I think it comes back to the stage is so important, like at what stage of the company you're in, and making sure it's a good fit for you and a good fit at the right time. So let's talk about, you guys can, this is an opportunity for you guys to talk a little bit about your fund and what you guys are looking for. What are some of the most important factors you consider? Is it growth rate, traction, sales, team dynamics, founder experience, those types of, what are the most important factors?
I think I mentioned our investment size already, but so we're strictly tech, and what does tech mean, right? It's basically across the board, but some of the key areas of focus for us are B2B SaaS models, Internet of Things, mobile-first platforms, and marketplaces. So those are just like the 4 things that kind of resonate with us. We're totally open to looking beyond that. But those are the things that seem to be working really well within our portfolio right now. Our initial smell test, if you will, for any entrepreneur is, do you have a product that's fully built, and do you have some sort of customer base? We've gone pre-revenue on companies that we've invested in, but they also had about 10,000 beta customers, using the product and iterating on the product. So they had some really good validation on that. So that gave us the knowledge to know that when they went to market, that there was going to be, and they started charging for it, there was actually going to be a market for it. Let's see, what else? Founder experience. I'm totally not afraid of investing in first-time founders. I think a lot of times they're the most hungry, and they're not biased based on past experiences. If they do have experience, obviously relevant experience is nice on that level. But you're seeing that a lot in Minnesota for sure. Is a lot of first-time founders, which is really exciting. I mean, I think it's a lot of people starting to make that leap into that. Previously, there was a lot of repeat founders, and you just invest in this one guy and do it again and again and again. Worked out pretty well on that level, but in other markets, you're starting to see that new generation come through, and we're starting to see that through in Minnesota. So definitely not afraid of a first-time founder, but you got to have that vision, you got to have some sort of product, got to have a interested customer base, and then from there, obviously, there's a whole other level getting into that, but that's the stuff we look for on the whole.
Cool.
I can talk about healthcare a little bit. I know that's a huge focus here. We are intentionally not med device, which I know that's going to pain a lot of people to hear because that's like what we are best at in the Twin Cities, but it doesn't scale. You got to have software, you got to have technology to really get that, well, not always, but vast majority of the times you get that outsized return, it's because of software. Mark Andreessen says software is eating the world. I kind of agree with him. So within healthcare software, that's sort of our focus, and the things I look for are very data driven. I did some research for the Kauffman Foundation, and what I found from looking at exits in healthcare IT companies in the past decade, all the big exits, only about 30% actually had any healthcare experience at the founder level. So I agree with you. I'm not at all scared to take a shot on someone that doesn't have, quote, experience. Hopefully they have managerial, operational experience, but it doesn't have to be like, oh, I was a 30-year vet at Medtronic and I went outside and started this company in healthcare. Not at all. But you do have to figure out your revenue model. In healthcare, it's absolutely critical. Every single one of those companies, 100% of the big exits had early revenues before they took funding, and that was like the biggest thing I could point to is you got to have revenue, because in healthcare, it's not about having the best technology, it's about figuring out how do you get paid, and that's really hard. So if you can get that figured out, that's what I'm really excited about.
Cool.
Yeah, I'll just kind of paint the sort of company that really gets us excited. So starting kind of where Ryan did, so SaaS business models. So that's kind of the first cut. The next cut is actually what the business model looks like. So we have a tendency to get really excited at the early stage about lower price point, high customer volume companies. So we're going to be way more excited if a business has 3,000 customers paying them $30 a month than 3 Fortune 500 companies paying them $333,000 a year. So from there, we look at actual traction, right? So for us, we don't have any rules on what we do or do not do, but oftentimes companies will have anywhere from $50,000 in monthly recurring revenue to $150,000. Oftentimes they're bootstrapped or minimal capital raised. So those are kind of like the checkmark stuff. But what really gets us excited is when we meet a founder who has a lot of vision for the product, and quite frankly, it's a vision we don't understand. So when you can kind of marry, hey, they've got a lot of people paying them for what they have today, and they actually have this vision of where they want to go, and it seems a little bit off and not exactly something that we would have thought of ourselves. When all of that happens together, we get pretty excited.
Awesome. I can't help but listen to you guys list like your criteria. It sounds like, I love the dating analogy. You guys are like all listening, like we like long walks and hiking and ice skating. I think somebody already said this, but Mark Susser, I think I've heard this quote all the time, that finding venture capital, finding any equity partner, even though we can talk next about giving equity to a co-founder, once you share equity, it is worse than a marriage, right? It's harder to break that up. It's much easier to get an actual divorce than it is to break up a business partner like that. So can you guys add just a little bit more on why it's so important to vet that relationship, to date and really understand and make sure you guys fully understand the entrepreneur and the entrepreneur fully understands your expectations? Speak a little bit about that as well.
Yeah, I think just to expand a little bit on the analogy that you're talking about, even when you give equity to a potential partner, a lot of time it's vesting, right? So, it's not one of those things where they automatically get it. When someone buys into your company, they actually own that equity until you actually have a liquidation event or you buy them out. So, yeah, it's one of those things where you're partners over a long period of time. There's obviously, positives and negatives and highs and lows that happen during that partnership. But ultimately, you have to vet the person, right? You have to make sure that they're going to react the way that you want them to react in tough situations. And I think the only way that you do that is by vetting them and talking to other people that they funded. So I don't have a ton to expand on from the quote, to be honest, because I think it's kind of self-explanatory on what it is. But yeah, you're not going to go to your investor and say, hey, I want you out now. So I think what matters a lot of times is terms, right? You should spend your time making sure that the terms in your equity agreement are very standard. There's a lot of stuff out there. It's probably a term sheet in startup deals, right, in the book. I think you want to make sure that you've got market terms such that you're not giving up too much to your company, not only from a dilution perspective, which is what entrepreneurs focus on a lot, but also just the other terms. Who has control of the company? What happens if you want to sell the company? What happens if you want to raise more capital? What happens if you want to expand the board and stuff like that?
Right. It almost reminds me like a prenup.
Yeah, it actually
So this is maybe news. As I learn more about the process, so there's, depending on the terms, depending on what's market standard. So in theory, if I were to take money and then things go south and I just want to sell, you guys can have terms in the deal that makes sure you guys get your money first before anybody else gets money, et cetera. So those are important details you want to know, right, before making a deal like that.
Yeah, the liquidation preference,
Yeah.
That's an important thing. No, I totally agree about the due diligence side. That is like a prenup. That is like dating before getting married. You want to make sure things are right before you just jump into it. But I'd say sort of one way to expand on this would be, how many of you are married out there? Okay, how would things go if you started acting transactional with your spouse? What would the relationship be like if you said, oh, you want me to take out the trash? Okay, well, only if, and you start bartering one for one on everything. That's a mindset that I see a lot in business, and it doesn't work in entrepreneurship because you're trying to build something over the very long term. You need to trust people, you need to have this relationship. So, like in a good marriage, you have to just commit to the relationship and everybody tried to contribute. And I realize that's kind of idealistic, but really that is what it takes. And when you look at some of these big unicorns, and if you get a chance to, just actually like hear those entrepreneurs and investors in like a fireside chat and talk about the journey together, it's always amazing to hear those times where it could have fallen apart very easily, but the one side decided to just trust the other side.
Yep.
And you wouldn't have got to that point without really building over the course of time. And
as much as we try to make it all objective and measurable and lawyer friendly, there's always that hidden element, right?
That's right.
Cool. Very good. Do you have anything to add, Ryan?
I would just say, make sure that if you take money from anyone, you should be excited when they call you, right? Like if you're getting a phone call and you're like, oh shit, Ryan's calling me, that's probably, that should not be the person that you wanted to take money from, and vice versa. Like I think that same way from the entrepreneurs we invest in. Like when they call or they email, I should be like, oh my God, I'm so excited to read this, to talk to them, to hear what's going on. I want to help and support. Like you got to have that kind of extra thing, and it's very much the dating analogy, right? You want to get that return call and get excited about it.
Good stuff. All right, let's switch gears a little bit into the idea of using equity another way, instead of just to raise VC, but to take on a co-founder, to bring on a crucial or a strategic employee. How would you recommend finding and structuring that relationship? I think there's some commonalities here in making same things apply. It's harder to split this apart than it is a marriage, right?
Yeah, absolutely. I think so. When you're an early stage startup, you don't have much cash. You're trying to generate that stuff, but the one currency you do have is equity, right? And you got to use that to your advantage as an early stage founder. And from an investment perspective, it's important that the early stage people have equity, so they're bought into it, because if things hit the fan, then you want them to be invested in it, even if they're not making a bunch of cash from it.
Do you care about the two-founder thing, where it like helps you mitigate risk by having two founders instead of one?
Ideally, we have three founders on our teams. We like to have them have different skill sets, especially in early stage tech. If you have certain skill sets, you can create a lot of value off of that very quickly at a really early stage. But and then how that is structured is really important. Like who's got the most equity, and what's their role in the company, or is there like a third person who owns a third of the company but doesn't operate? And it's like, well, that's dead weight, to the company. So the cap table is fairly important, more so about who has what and when, because it's the incentive structure that is in place for early stage companies. I think the one commonality you find is that, and I think it's becoming more and more, is the vesting, right? So a lot of the founders will have some sort of upfront, like, boom, we're each taking 20%, and then we're going to vest the rest to each of us, because who knows, someone might leave the company, and you don't want to leave with a third of the company with them. And for really any early stage employee that you take on as well, there's usually some sort of 4-year vesting schedule over that time, so they earn that. And lastly, I don't know if I'm taking all your points here, but we also look for some sort of equity pool that's already in place, right? It's usually about 10 to 20% of the company set aside strictly for incentivizing hiring employees. Because if we want to invest in your company, we want to make sure that you can incentivize people to take a risk. They're probably going to take less than their market rate from a salary perspective, so you want to incentivize them on the equity perspective as well. And if they are taking that risk, they deserve it. So make sure that's in place, so that you can really plan out your growth in your hiring schedule.
Cool, that's helpful.
Yeah, that was great. One thing to add, put in the time, think about it. It doesn't have to be equal. Just to say, oh, there's 3 of us, we each get a third, is a cop-out, and it's going to come back to haunt you. I read a great book, I'm blanking on it, but he talked about management debt. Basically, when you take a shortcut because you don't want to deal with a problem, you're accruing management debt that you have to pay off later in the form of some misalignment. And this is like that. You don't want to be short-sighted when you're not thinking through all the issues. And if you're facing this, there is a good book called The Founder's Dilemma by Noam Wasserman that looks at all the various, he's got a great logic diagram that says, is this you? Are you facing this decision? Yes, no, whatever. And it really is a good guide. So I'd recommend that. But really, when I think about sort of co-founders and the overlapping of their skills, I also look at their networks. And who do you need? Like, if you have a strong network of investors, but you don't know anybody, in the coding circles, like, well, obviously you got to go get a CTO that's going to be able to bring those people in. But you should think about equity aligning with what are you bringing to the table, as well as what are you going to contribute in terms of your time and your effort, and that's why you vest and that kind of thing. But also think about the capital, the political capital, social capital, actual financial capital that you're bringing to.
Yeah, the only thing I would add is I would be very, very specific in spelling out the expectations for the person that you're giving a material amount of equity to. And this is something that we've seen come into play multiple times, which is, I'll just give an example of, you've got someone that you want to give a large chunk of equity to as a kind of co-founder, either technical lead or like a COO or something like that. But you find out that that person's a valuable member of the team, but the company's scaling past them really quickly. Mm-hmm. And they're not actually going to be able to serve in that capacity over like a 3 to 4 year period. So we've absolutely had situations where someone was given an equity grant, and then collectively at the management team level, that person acknowledged, hey, I don't want to be a senior leader interviewing people all the time and just being in HR all day and not working in the details. And we've actually altered equity from the initial agreement.
Wow.
Because we actually spelled out, here's what the expectations were when that was given, and it was a very amicable situation, and it wouldn't have been if we weren't very clear. And it just avoids one of those things where all of a sudden 3 years down the road, you're looking at someone who might still be active in the business, but they're sitting on 25% of the company, and you're kind of like, geez, they were there at the beginning, but really, do they really deserve that much today? So I'd just be very specific on, their title, the expectations, such that if you get into one of those situations, you can have an honest discussion down the road.
Cool. I think what helped me early on, I was founded by myself, and I think this whole idea of equity is that it's almost impossible to grow a big sustainable company alone. Like, you need help. You need to find complementary personalities and skill sets and networks, et cetera. But it's scary to share. How do I slice up your baby? Like, everybody, with the analogy, we've talked about marriage. Oh gosh, that's bad. Sorry. I can never be a politician. So my point was, finding a partner is like getting married, but then starting your own business is like having another child. And it's very hard to, like, how do I share this? I don't want to split it up, and how much is it worth? All of this stuff. When I learned these concepts of a cliff and a ramp, it helped me baby step into this idea of taking on another strategic partner. You guys want to speak to those concepts and how it helps out and it helps mitigate risk?
Yeah, sure. So in a lot of these things are structured different ways, but let's just use a really simple analogy of, you're going to give someone, hey, I'm going to give you 10% of my company, and it's going to vest over 4 years with the 1 year cliff. Mm-hmm. Okay, so what that will mean is that up until the first anniversary date of the company, if the person is no longer at the company during that time, they walk away with nothing.
Yep.
Okay, once
it's like
they
a dating period.
Correct. Once they hit the 1 year anniversary mark, they will immediately vest 25%, which is 1/4 of that, right, over one over 4 years. From there on out, I mean, it can vary a little bit. Some people do it where they actually do increments every year. Most often from that point, people will start earning equity on a monthly basis. So what would happen is on month 12, you get 25%. On month 13, you've got the 25% plus, 1/12 of another 25%, right? And it kind of adds up over time. If that person were to depart the company at any time after that, they'd be, entitled for the right to purchase that amount of equity. So it's not like they just walk away and they have that forever. I mean, if it's founder shares, it's a little bit, you could do that. It's more about the strike price on the equity. Mm-hmm. Oftentimes they will actually have to purchase if they leave, if that makes sense. So what that does is, let's say you just know in the first 12 months it was a terrible hire, not a fit. You can actually remove someone without that impact to the equity. Whereas if you just would have given them 10% up front, that's a mistake. So it's just kind of a way to make sure that incentives are aligned over a long period of time. Is that consistent with what you guys have seen? Okay.
I'll speak for myself. I was so terrified of, like, how do I find somebody and know that I can trust them with 10% of my company? Like, I'm one, when I hire, I don't like spending a lot of time in the interview process. I'm like, here's a project. I'm going to hire you as a consultant. Let's work for a month together to actually see if we're going to be a good fit. How can I do that with equity? Like, I don't want to just, I'm hearing all of the risk involved. Like, once I've got to make the decision perfectly, I think they're a good fit, the resume says their preferences, but how do I make that huge, scary, like, yes, here you go, here's 10%. And learning these concepts helped me like, oh, I get to like tip my toe in the water and work with this person for a year to make sure that they're as good of a fit and the right fit for the company, personalities fit, we work well together, then they start taking equity. So that was a huge win for me. And since then, the person I was able to take on as a COO, I can't speak enough about how important it is to hire people not like yourself. And one of the other big pieces of advice was hire A players. It's really, when you hire a B player, they like to hire C players. And so when you always want to hire somebody who's better at you than doing the thing you're going to pay them to do. So those are just pieces of advice that I've received and passed on. Okay, so I think this is really good. If you guys have any other questions, I think now's the time to ask each of them. But I wanted to also share this great resource that I used in learning a little bit about this, entrepreneurship.org. They've got a great series on financing your venture and all kinds of awesome resources. I really wish I would have found this early on. It's really good stuff. And then Steve Blank there's a lot of top leaders in this space, but I just wanted to share one of my favorites. His startup tools page is probably the most exhaustive just list of all things startup and lean startup and things that I really like referring people to. All right, any questions? So are we good on time? Go ahead. We got one in back real quick.
Can you guys talk about why values in the Midwest are so much lower than values in California? And will that ever change, you think, in your opinion, as more success comes out of the Midwest?
You go.
Yeah, no, I think here's the way I would look at it in terms of, and I really only have, I have the most insight into the seed and Series A. So I think that the valuation gap between the Midwest and we'll just broadly call Silicon Valley is the most pronounced the earlier you are, and then it converges over time as the business has traction. Okay, so I would actually say I actually feel for a lot of the Series A businesses that I see that are, let's say, $1 million run rate growing fast. I mean, there is a discount, but it's not like half. Right? I think over time the valuations will probably increase. The ding that a lot of folks will give on the Midwest is, hey, there's just not this high volume of exits in the Midwest, for every exact Target or Groupon or whatever, there's 50 of them in the Valley. So I think over time there is more success, it'll breed more success, but I also just think it's just the overall environment. And I think there's always going to be a gap over time. But we're definitely seeing the valuation gap converge. We've had some companies raise growth rounds of what I would consider to be very, very strong market multiples. So hope that helps.
There's a question up front.
My kids love Shark Tank and all the other things associated with it. So compare your companies to how they perceive, or at least on TV, how they operate. Give me an idea of the differences.
They just come in and meet you guys for like 2 hours and then make the deal, right?
It's like 10 minutes.
Right.
So real quick, the most obvious is,
there we go.
Okay. The most obvious is they pursue very product-focused things. It's things that it's a show for TV, right?
Right.
So the average audience member is not going to understand a tech company that's rolling out something crazy. So they have products. You can see it in Target. You can see it on QVC. It's very much that mindset. That's not venture. That's not going to change the world. It's going to lead to a nice little exit, perhaps. They're going to get maybe 1 to 2x on their money, but it's not going to be a huge thing. That's why, Mr. Wonderful with all his royalty plays, it's like that is the best model for that. Get your money back. Otherwise, they're not going to get their money back. And if you look at the data, most of those fail. And not more than just what you would see. Like all those sharks, I want to say, have lost money, but it's for the PR and them being part of it. So it's a wash, I guess.
Yeah.
They get paid to do it too.
Yeah,
right? I think what Shark Tank has done is really put it on the VC process in public a little bit more. So I do give them credit for that. They're basically taking like a 2-week to 6-month process down to like 5 minutes, down to that. They're just like hyper. They also don't tell you that they probably research this company. They already know a ton about it before they even go on stage, and they're all prepped for it.
And Mark has said that they're actually in the room for like 2 to 3 hours.
Oh yeah,
they cut that down.
They make it seem like they're like, oh, tell me about your business, and it's like they already know.
Yeah, right.
I think they also take equity just for going on the show.
Mark took that rule out.
Did he? Okay.
Yeah, he's like, I'm not going to be on the show unless you take.
Okay, yeah, I know for a while they were like, if you want to go on the show, we get equity.
5%.
Yeah, it was ridiculous. Yeah, I mean, that's not reality in the least bit on that. But I guess some of the tenets of how it is done is in there. You know, they talk about valuations and they're negotiating and all that stuff, and that is what is done, I guess, in a longer form.
Yeah, I think that's the only thing I would add is that the biggest misconception would be that, you know, I've never once bartered valuation with the company in a meeting, right? You know, people come in like, hey, I'm raising at 6 pre. I'm not like, you know, 4 pre with the 20% royalty, right? And like they're just like trading back and forth. It just like absolutely does not happen that way. I think that's probably the biggest.
Yeah.
And we don't beat up entrepreneurs that I feel, you know, sometimes they're like laughing at people. They're like, oh my God, you've only sold this. Like it's not like that.
That's bad TV. Watching you would be pretty boring.
It would be very boring.
I think I'll end on a good note. I think one of the positives of Shark Tank is that the first thing that they're hammering home is that ideas themselves are not that valuable. Nobody invests in ideas. People investing, they invest in like proven something with a track record, right? With sales. With that first question, they ask, okay, what are sales? What are sales? And I think that message getting out to the public in early stage entrepreneurs is probably a positive one. All right, thank you guys so much for your time. Thanks for attending, everybody. Really good stuff.